everybody. Welcome back for another Fratarcangeli Friday market update. None too soon with the last couple weeks being very volatile here in November. I guess we would say November is the new September because historically, September is the month that we get high volatility, but we did not get that this September. Knowing that earlier this year in April, we had some major declines in the market to the tune of roughly 17% down on the NASDAQ as of that date in April 7th, and the S&P was down 13. We thought maybe we had dodged the September, call it market volatility, but here we are with the NASDAQ down 3.6% for the month of November and a lot of pressure on technology. I would say it's healthy. The market going straight up like I had endured back in the 90s when I first started in the business, I thought that was normal. And then we paid for it dearly in the early 2000s and throughout the 2000s with a very anemic market. I will tell you, if you're building a skyscraper and you don't test the floor below you before you build the next floor, you could collapse all floors at some point. And I think this is a great example of that. We are testing support levels in areas of the market that have been extremely robust since April 7th on the upside. I would call that healthy. I would also call this market not done with the expansion. Living through 30 years of market volatility, I have seen a bubble. I have seen irrational exuberance. I've seen a euphoria in trading that is at end of a market. This does not feel like that. Let's look at the data to see what that states. We're coming off of third quarter earnings. 82% have beat on the top line as well as the bottom line on earnings. So we're seeing very strong earnings growth for the third quarter. What's even more compelling is the guidance going forward, staying very strong. So not only do we see a nice earnings report year over year for Q3, which looks like a 7% earnings growth from last year at this time, but we're also seeing guidance staying consistent with stronger earnings for the next year. We're looking at double-digit earnings growth for the current year, and that goes now for the fifth straight year. We're calling for 13% earnings growth next year. And the data and the reports that we've seen so far with the third quarter have supported that detail. I think this stands for continuation of expansion. We also have to concern ourselves with valuation, especially on the heels of the tech sector continuing to expand with some of the top names carrying this market. We call them the Magnificent Seven. 40% of the S&P is being driven by roughly 12 companies. And so one would say, as they look at their performance, why am I not performing as well as some of these big tech stocks? Here's an example of why you diversify, why you don't have a heavy emphasis in any one sector or any one company. You balance out your portfolio between value companies, the benefactors of technological advancement, and growth companies that disrupt. You have to have a balance to both. And my team here at Fratarcangeli Wealth Management guide our clients as to where we should position each account type, like retirement or taxable accounts, within those two categories to create a nice balanced portfolio, because we're getting a taste with the NASDAQ down 3.6% and the Dow Jones Industrial Average 2 days ago hitting a new high, which is comprised of mostly value companies. So this is a learning opportunity. One, I don't think this market's done. I think we have more upside. Earnings reports indicate that. Two, we're a little bit frothy on the valuation, trading at about 22 times earnings, with historical averages being closer to 19. This pullback, I think, could be healthy, but the earnings growth that we're anticipating will help offset that. We also have the government reopening. It's interesting. The government reopens 2 days ago. The market's done nothing but go down. What I can compare that to is, one, we're due. We're due for a pullback. We've been going up since April 7th. Two, imagine flying the friendly skies with no gauge for where you're at or where you're going. Well, that's virtually what we're doing. We don't have any data. We have no data from September and October telling us the unemployment numbers and the data that's going to tell us whether we have inflationary pressure or we're consolidating. That's just uncertainty, folks, and the market doesn't like it. The market's selling off. I also feel like there's some shorting going on. Someone's selling stock that they don't own, kind of betting on the market going lower, and that certainly could create volatility on the downside. But guess what? They have to buy their shares back at some point. And when they do that, the market will recover. I would say this is just part of the journey, folks. That's why we make sure we have enough liquidity to take us through the uncertain times, and our long-term money we're not touching for 5 years or longer, stays intact. Nothing's changed. We still have volatility. We're still going to have more upside. We have earnings growth that we look upon over the course of the next year based on what companies have told us. I would say nothing's changed. It's business as usual. We're here to make sure that we're taking advantage of these contractions with caution, and we're making sure we're reaching out to you to make you aware of what we anticipate. So I look forward to talking to you soon. Next week, I'm going to be bringing on one of our top analysts. I'll be sending an invite for a more prolonged discussion on where we're at in the economy, where we're at in the market, what we should expect for the coming year. What does this big, beautiful tax bill mean for the market? And what do we need to be doing to take advantage of it? I look forward to seeing you soon. Bye for now.